what to avoid with a line of credit. There are some things, some key pointers I definitely just want to throw out there, keep you informed when you're doing your research with the different credit unions and banks, certain things you want to avoid so that you have the best line of credit so that you can apply velocity banking for your situation, okay? So I just want to highlight a couple of things for you in this video. First things first is annual fees. Any annual fees or monthly fees. You know, if you see a line of credit that has an annual fee of 50 bucks, hey, if there's another credit union that offers no annual fees, shift your attention that way. Let's try to avoid transaction limits. What I mean by that is if they say you can only make 6 or 10 transactions per month with that line of credit, that's going to be a big delay for us. We don't want to have that. We want to have the ability to pull money out as many times as we like and put money in as many times as we like as well. Also, there are some personal lines of credits out there as well as HELOCs that offer an actual card, like a debit card, and you can use that to actually make transactions, okay? And there are HELOCs and there's personal line of credit out there that I believe you can actually set up direct deposit to actually go right into that line of credit or that HELOC. It functions just like a checking account. If that's the case, definitely make sure that there are no transaction limits, unlimited transactions. That's what you want. Next one is high early withdrawal amount and closing fees. Definitely want to, be wary of that. It's not a big deal. Most closing fees that I've seen are maybe $1,000 at max. The majority that I've seen so far is like 500 bucks. Not too crazy. But high early withdrawal amount, what I mean by that is, let's say you got approved for a $50,000 HELOC and they say the minimum withdrawal from the very start is 25 grand. That might not be ideal for someone that only makes 3-4 grand a month. That might not be ideal because it's going to take you it's going to take us too long to pay off that 25,000 on the HELOC, even when doing velocity banking. I want to be able to zero out whatever our chunk is within like a 6 to 9 month period at max. I don't want to wait too long, okay? So definitely something to consider there. Now, if you got approved for a $50,000 HELOC and you make 10 grand a month, hey, 25,000 might be easy peasy to zero out in 6 months. Would you agree? Of course. Next thing is payment restrictions or prepayment penalties. What we definitely do not want is if we got approved for a HELOC or a line of credit and somewhere in the terms and agreements says, hey, if you pay off this HELOC before the maturity date or something like that, that you're gonna have to pay the closing fees or something. They might throw in little nitpicks. That's why it's very important to read between the lines. They do this to play games, okay? And then the payment restrictions, there might be some personal line of credit out there or even HELOCs. Maybe you're not allowed to pay a certain amount. Like there might be a restriction. I don't know. I've seen different ways that they will allow, that they'll take payments, okay? So you want to make sure you're kind of paying attention to that. And this payment restriction has to also do with this one right here, interest only payments, okay? That is one example of a payment restriction. So literally, if you got a HELOC with interest only payments, that means your monthly payment, the minimum monthly payment, that whole thing is interest only. I'm not saying they're the worst thing to have, but in the scenarios that I've ran, the stories, the clients that I have that own interest-only HELOCs, they're not exactly happy to a certain degree with them. So, and then not only that, let's use that same example. If you got a $50,000, $100,000, $200,000 HELOC, and you only make 4, 5, 6 grand a month, and you have this interest-only HELOC payment of $1,000 or 13 or 500, understand that if you don't put in your whole entire income, that's 1,300 or 1,000 or 500, whatever it is, all interest. Okay, so that's why it could kind of hurt us when we're doing velocity banking to a certain extent. So I would try to avoid that. I would just go with the principal and interest payments. I prefer those. That's my opinion. Okay, on any debt tool, I would aim for an interest rate of 15% or lower. Okay, is it the end of the world if you got a line of credit at 18% or 20%? No, it's not the end of the world. All I'm saying is try to aim low. Try to get that 8%, 10%, or even lower than that. 6, 5, 3. They're out there. Okay? And another one I want you to avoid big time is maxing out your HELOC or your personal line of credit. That's not smart. When we're doing velocity banking, we're trying to make strategic chunks to specific debts that allow us to offset whatever interest I pay on the line of credit or the HELOC itself. So here's an example. If I have a $50,000 HELOC and I take $20,000 from that 50 and make a chunk towards my mortgage or towards a car payment or student loans, that $20,000 that's going towards that other amortized debt, my goal is I want to, I can even put this through a calculator. I want to see, okay, if I made a payment in February, how much interest did I save just off that one principal payment, right? And we can look at that, especially off of a mortgage or a student loan or car payment. We can see just how much interest we shave off the back end, right? So if it's anywhere in the thousands, right, or maybe even 10,000 or more than that in interest savings alone, and then the principal payment on top of that, that's a big cushion for the amount of interest that you pay on the HELOC or the line of credit itself when we're doing velocity banking. Okay, so just to recap on everything, definitely write this stuff down in your notes so that when you're calling the banker, so that when you're reading these terms and agreements, you can really look through every single one. I will say this, for your very first line of credit or HELOC, for your very first one, depending on what situation you're in, listen, if you didn't meet any of these requirements, it's not the end of the world. Okay, one thing I would say that is definitely a must to avoid is that one. You must avoid that because that can kind of fall apart on us. Okay, the payment restrictions, definitely keep an eye on that. That's more of a behavior one. You definitely don't want to ever max out your HELOC or your line of credit. So that's why in many situations I'm kind of against the idea of taking a big HELOC and just taking that whole entire, maxing out the whole thing to pay off one mortgage or to pay off a bunch of different debts at once. I don't like the idea of that. You're just simply borrowing from Peter to pay Paul in that sense. And then if you don't have your velocity banking numbers tight, if you don't know what you're doing, it could backfire. Okay, so velocity banking can backfire if you don't have all your information, if you don't have the education, if you don't have an accountability partner, someone to coach you along the way. It can certainly backfire, okay? Especially if you're investing in different, areas in your life. You have a business, you have your job, you have your side income, whatever it is, and you make this large chunk, right, towards a debt, and you mess yourself up, you put yourself in a hole. We don't want to do that, right? So be sure to keep an eye out on these little factors that I have on what to avoid when using a line of credit. Have a wonderful day. God bless.